Usually, when you talk about a legendary athlete making a late career comeback, there is this immense, almost cinematic expectation.
Oh, absolutely.
Yeah, you picture the montage, the early mornings, the grueling training, the sweat, the relentless focus. The narrative is always about heart. You watch them step back onto the field, and the entire stadium just holds its breath, right? Just waiting for that spark of the old magic.
Right, because it is deeply emotional. As an audience, you want the comeback to be real because it validates your loyalty.
Yeah.
I mean, you inherently want to believe the story that the athlete is telling you.
Exactly. It is comforting. We like to root for the legacy. But then you step into the world of corporate finance, and suddenly that cinematic montage just doesn't matter anymore.
Not even a little bit.
No, we are looking at a landscape where a beautifully crafted narrative is colliding head-on with cold, hard ledgers. And honestly, the reality is incredibly murky.
It is the absolute definition of diagnostic muddy waters. The scoreboard shows they are currently losing to the clock, no matter how inspiring the halftime speech sounds in the press release.
So we are jumping right in today. We're evaluating the financial health and the massive, highly publicized strategic turnaround of an absolute global titan. We are talking about the swoosh, the cultural behemoth, Nike, Inc., traded on the New York Stock Exchange under the ticker symbol NKE.
The one and only.
Yeah, if you have worn a sneaker in the last 50 years, you know them. This is the worldwide leader in the design, marketing, and distribution of athletic footwear, apparel, and equipment. I mean, this is a brand that hasn't just participated in modern sports culture. It essentially defined it.
It did. And my role today on this deep dive is to establish a strictly rigorous, objective baseline. We're going to strip away the marketing jargon, completely bypass the emotional appeal of the brand, and audit the actual numbers.
Which is exactly what you need to hear.
Right. Because if you are evaluating this company, whether as an investor, a competitor, or just an observer of global markets, you have to anchor your analysis in reality. Nike's current market capitalization sits exactly at $90,392.42 million USD.
Wow. Okay. Down to the decimal.
We have to be exact.
Yeah.
We are grounding our entire audit today in the latest Q3 fiscal year 2026 quarterly report, which ended February 28, 2026, and was just reported on March 31. We will also be cross-referencing this heavily with their Q2 earnings call from December and pulling vital historical context from their annual 10K reports going back to fiscal 2023.
And to understand why this deep dive is so critical right now, you really have to look at the macro trend. You're looking at a company that has been historically dominant, right, an unstoppable force, but the trajectory has shifted drastically in recent years.
Drastically might actually be an understatement. Let's look at the historical revenue trend just to set the stage for you. In fiscal year 2023, Nike reported $51.2 billion in revenue. In FY24, they ticked up slightly to $51.4 billion.
Which looks fine.
Right, it looked like business as usual. But then we hit the cliff. In FY25, revenue dropped massively to $46.3 billion.
Ouch.
Yeah, that is roughly a 10% contraction for a company engineered and priced for perpetual growth. Now, if we look at the latest Q3 2026 revenues, they came in at $11.279 billion. Compared to the exact same quarter last year, which was $11.269 billion, that is essentially flat on a reported basis.
Which, if you listen to the PR machine, is being framed as stabilization. They stopped the bleeding.
And the PR machine is relying on an illusion. You have to look at the currency-neutral basis. Because Nike operates globally, they deal in euros, yen, yuan, pounds.
Right, the exchange rates.
Exactly. When the U.S. dollar is strong, those foreign sales translate back into fewer dollars. Management loves to blame currency fluctuations when sales are down. But even when you strip away those currency effects, when you look at the raw organic volume of goods moving out the door, revenues are actually down 3%.
Oh, wow.
So the underlying reality is a continuing contraction, even if the top-line dollar amount looks deceptively stable.
Which brings us back to that comeback analogy. You have CEO Elliott Hill deploying this highly publicized win-now strategy, trying to get the team back in fighting shape, trying to rally the base. But the numbers under the hood just aren't cooperating with the narrative.
Moving to point one, the number drill down and profit margins.
Let's get into this because I want to play devil's advocate for a second. The revenues did stabilize at flat year over year in Q3 2026.
Sure.
To an optimist, to someone buying into the win now actions, this suggests that management has finally found the floor. I mean, the drastic drops from last year aren't repeating. Doesn't that count for something? Aren't they holding the line?
Holding the line on revenue means absolutely nothing if the cost of holding that line is destroying your profitability. If we actually look under the hood at their profit margins, the story falls apart entirely.
Okay, break that down for us.
Let's dismantle these metrics because the true operative development here shows a severe, undeniable downward trend across all margins. First, let's examine the gross margin. In Q3 2026, the gross margin dropped 130 basis points to 40.2%.
Okay.
If we track the historic decay, it is alarming. In FY24, the gross margin was 44.6%. In FY25, it fell to 42.7%. Now, it sits at 40.2%.
For anyone listening who doesn't stare at P&L statements all day, explain the mechanism here. Why does a drop from roughly 45% down to 40% matter so much? It sounds like just a few percentage points, but I know it's a massive deal.
Think of gross margin as the fundamental speed limit of a business. It is simply the difference between what it costs Nike to make a sneaker and what they sell it for, before any other corporate expenses are paid.
Right.
When that margin evaporates, it tells you exactly where the pain is originating. Why is it dropping? Management cites two things: higher promotional discounts and a shift away from their Nike direct business.
Meaning they are putting things on sale.
Aggressively. They are essentially paying consumers to take the product off their hands through markdowns. You don't discount the hottest sneaker on the market, you discount the inventory nobody wants.
That makes sense.
Simultaneously, they're shifting sales back to wholesale partners like Foot Locker or Dick's Sporting Goods, who naturally demand their own 20% or 30% cut of the profit.
Yeah.
But the deterioration doesn't stop at the gross level. Look at the net margin, the actual bottom line.
What's the damage there?
It plunged to 4.6% in Q3 2026, down from 7.0% in Q3 2025. To give you context, back in FY24, Nike's net margin was over 11%.
Wait, from over 11% down to 4.6% in just a couple of years.
Yes.
That means their actual take-home profitability was cut by more than half.
Exactly. And the EBIT margin, earnings before interest and taxes, which measures core operational health, has been crushed down to 5.6% in Q3 2026 from 7.3% a year prior.
Wow.
What this means for you as an investor is simple. Nike is working just as hard to manufacture, ship, and sell the exact same $11.3 billion worth of product that they did last year, but they're keeping drastically less of that money.
Right, because of the discounts and the middlemen.
The pain is originating from immense pricing pressure, bloating overhead, and a fundamental breakdown in their premium pricing power. People just aren't willing to pay full price for the swoosh the way they used to.
That paints a much darker picture than just saying revenues are flat. Flat revenues hiding collapsing margins is a dangerous combination.
Moving to point 2, one-off effects versus operative development.
Okay, here is where it gets incredibly interesting. Because when you listen to CEO Elliott Hill and CFO Matt Friend on these quarterly earnings calls, they are constantly talking about the costs associated with this win now strategy.
Oh, constantly.
Yeah, they talk about realigning teams, right-sizing the classics business, and variabilizing the P&L. To me, that sounds like a company taking the bitter medicine now to get healthy later. If you have to fire some middle managers and restructure divisions to turn the ship around, well, that's just the cost of doing business, right?
That is precisely the kind of management speak we need to aggressively dismantle on this deep dive. As an auditor, my job is to question what management conveniently classifies as a one-off or non-operative expense.
So you don't buy it.
Let's look at the severance pattern, because it is incredibly revealing. In this latest Q3 2026 report, they booked $230 million in severance costs directly into their operating overhead. Management frames this to Wall Street as a one-time strategic reset, a special charge.
Right, a one-off.
But if we pull the receipts from FY24, just a couple of years ago, we see a massive $443 million restructuring charge, primarily for employee severance.
So they did this massive one-time restructuring 2 years ago, too.
Precisely. Which brings up an essential question for anyone evaluating this stock. If a company is booking hundreds of millions of dollars in severance and restructuring charges every single year, is it truly a non-operative one-off event?
I mean, probably not.
No. Or is it simply the expensive recurring reality of a failing strategy?
I see what you mean. It is like an athlete claiming their poor performance is due to a one-time hamstring injury, but they have torn that exact same hamstring 3 seasons in a row.
Exactly.
At a certain point, it's not a one-time injury, right? It's a chronic condition. If you are constantly restructuring them, restructuring is just your business model.
That is a perfect analogy. You cannot continuously shield your operating margins By tossing massive expenses into a special effects bucket to make your core business look healthier than it is.
So what does it look like without the shield?
Let's calculate the true operating profit. That EBIT margin we just discussed is an already weak 5.6%, but that 5.6% includes the protection of treating these firings as strategic realignments.
I see.
Without that $230 million severance shield acting as an excuse for poor performance, the underlying operational efficiency is utterly anemic. You simply cannot let management excuse this as a one-time anomaly. This is a recurring symptom of deep strategic instability.
They are bleeding talent and burning cash to do it and trying to convince us it's a feature, not a bug.
Moving to point 3, the balance sheet quality and debt check.
Well, looking closely at the balance sheet, I do see what looks like a genuine bright spot. Inventory is down 1% year over year to $7.48 billion in Q3 2026. Given how much trouble the entire apparel and footwear industry has had with bloated inventories and warehouses stuffed with unsold goods over the last few years, doesn't management deserve some praise for finally clearing out those backlogs?
I am going to completely ignore that minor 1% inventory fluctuation because it is a distraction from a massive glaring red flag sitting right next to it on the balance sheet.
Oh, what's the red flag?
Let's look at the accounts receivable. In Q3 2025, receivables were at $4,491 million. In Q3 2026, they shot up to $5,369 million.
Let me do the math on that. That is an $878 million increase.
It is a 20% spike in receivables. Now, connect that to the revenue line we discussed at the very beginning of this deep dive. Revenue is entirely flat, 0% growth.
Wait, explain how that works mechanically. Sales didn't grow at all, but the money owed to them grew by 20%.
Exactly. And this requires rigorous investigation. Accounts receivable is simply the money that wholesale partners like big department stores or sporting goods chains owe Nike for products they've already received.
Right.
When receivables grow at 20 times the rate of revenue, it strongly implies a practice known as channel stuffing.
Channel stuffing. Okay, break that down for us. What does that actually look like in practice?
Imagine Nike is approaching the end of the quarter, and Wall Street is expecting them to hit $11.3 billion in sales. But consumer demand is weak.
Okay.
So Nike goes to a major retailer, say Foot Locker, and says, "We need you to take 100,000 pairs of these new sneakers right now." Foot Locker says, "We don't have the cash to buy those, and we don't know if they will sell."
Makes sense from Foot Locker's perspective.
So Nike responds, "Don't worry, take the shoes now, and you don't have to pay us for 90 or 120 days.
So Nike gets to record that as a sale on their books today, which makes their revenue look stable. But the cash hasn't actually traded hands. The shoes are just sitting in a Foot Locker stockroom instead of a Nike warehouse.
Precisely. They are extending overly generous credit terms just to push product out the door and recognize the sale. It is a classic leading indicator that end consumer demand is softening much faster than management wants to admit.
That is terrifying if you're an investor.
It is. Now let's move to the debt check. Traditional leverage, meaning net debt to EBITDA, isn't the primary immediate risk here, which I will acknowledge. Long-term debt sits at $7.03 billion.
Okay, that's a big number.
It is. But with cash and equivalents at $6.66 billion and short-term investments at $1.397 billion, totaling roughly $8.05 billion, they are technically net cash positive. However, we cannot ignore the operating lease liabilities of $2.65 billion.
Which are what, exactly? The leases on their physical retail store.
Yeah. Yes. Retail stores, distribution centers, corporate offices, these are permanent fixed burdens on the balance sheet. They have to pay that rent regardless of how sales perform.
It's like having a massive mortgage on a giant mansion while your salary is getting cut in half. You might have some savings in the bank, but those fixed costs don't care about your profit margins. The bank still expects its check every month.
Moving to point 4, the cash flow.
Okay, despite the margin compression and despite this alarming receivables issue you just outlined, Nike continues to reward its shareholders. In Q3 2026, they returned $609 million in dividends, which is actually up 3% from the prior year.
Yes, they did.
They are keeping their 24-year streak of increasing dividend payouts alive. That projects immense confidence to the market, doesn't it?
That does not project confidence. It projects a dangerous, almost stubborn disconnect from financial reality. We need to deconstruct this cash flow quality using exact accounting formulas because the way management is reporting this is obfuscating their true ability to generate cash.
Okay, let's do the math.
Let's look at the dividend disconnect. We just established earlier that Q3 2026 net income was 4.6% of $11,279 million, which gives us roughly $518.8 million in actual profit.
Right. So after all the bills are paid, they made $518.8 million.
Yes. Now look at what they just paid out in dividends to maintain that PR streak.
They paid out $609 million. Wait.
Exactly. They paid $609 million in dividends out of only $518.8 million in net income. They're paying out roughly 117% of their actual earnings.
It's like draining your entire life savings just to make sure your neighbors still see you driving a brand new Porsche. It's fundamentally unsustainable. You can't pay out more money than you make forever.
It is deeply unsustainable. They are draining the corporate treasury to maintain an illusion. But it gets substantially worse when we look at the accruals ratio.
What exactly is the accruals ratio, and why does it matter to someone analyzing this company?
The accruals ratio measures the difference between a company's reported accounting profit and the actual physical cash flowing into its bank accounts. It tells us how much of the earnings are just paper artifacts.
Okay, show me the mechanics.
Let's walk through the exact calculation because the mechanics are crucial. We already noted the $878 million spike in receivables. That creates a massive working capital drain. This is cash. Nike claims to have earned on the income statement, but hasn't actually collected from the retailers yet.
The channel stuffing.
Right. Given this drain, we estimate their operating cash flow, or OCF, to be roughly negative $692 million for the quarter.
Negative cash flow. So cash is actively leaving the business.
Yes. Now, their total assets stand at $37,064 million. The formula for the accruals ratio is net income minus operating cash flow divided by total assets.
So plug in the numbers.
So that is $518.8 million in net income minus negative $692 million, which mathematically means adding them together to get roughly $1.21 billion in total accruals. Divide that by $37,064 million, and we get an exact accruals ratio of 3.26%.
And a positive ratio here is a giant red flag.
A positive and growing accruals ratio means earnings are heavily reliant on accounting artifacts, specifically those uncollected wholesale bills sitting in the receivables column rather than actual cash hitting the bank. Their reported profits are an illusion of accrual accounting.
Wow.
Now let's look at the free cash flow yield, which is the ultimate test of a mature company. Assuming a normalized quarterly capital expenditure of roughly $200 million money they have to spend just to keep the lights on and maintain facilities, the estimated free cash flow is roughly negative $892 million.
Which means they're burning almost $1 billion in free cash in a single quarter.
Correct. If we annualize that against the exact market cap we established earlier of $90,392.42 million, this yields a deeply troubling free cash flow yield of exactly negative 3.94%.
Negative 3.94%. That is wild.
I pose this question to you, the listener. Can a mature, historically low-growth company survive long-term when its free cash flow yield goes negative by almost 4%, while it simultaneously forces out dividend hikes that exceed its net income by 17%? The mathematics simply do not support the comeback narrative.
That is a brutal reality check. I mean, you just cannot fake free cash flow.
Moving to point 5, share count and market capitalization.
Let's shift to capital allocation, because management has been aggressively buying back stock. They've retired over 124 million shares under the massive $18 billion buyback program that the board approved back in 2022.
Yes, they have.
The logic here is standard corporate finance, right? By reducing the supply of outstanding shares in the open market, they are theoretically increasing the value of the remaining shares for all existing investors. It's supposed to be a massive benefit to the shareholders.
Let's audit the actual return on investment of this capital allocation strategy, because theory and execution are two very different things here. Yes, the sheer mechanical reduction of the share count is technically true. Diluted shares decreased from 1,516.7 million in FY24 down to roughly 1,481.6 million in Q3 2026.
So the pie is sliced into fewer pieces.
But we must look at the immense value destruction that occurred concurrently. Let's compare the total market capitalization from the Q3 2025 publication sheet, which was $106,395.92 million, to the current Q3 2026 sheet, which, as we established, sits at $90,392.42 million.
So if I'm tracking this math correctly, the total overall value of the company dropped by $16 billion in a single year.
This is the unvarnished conclusion. Management took billions of dollars of the company's own cash they desperately need right now for turnaround operations and spent it on buybacks, artificially draining liquidity to prop up the stock price.
Just to keep appearances up.
Yet the total value of the company plummeted by $16 billion anyway. This is a massive destruction of shareholder wealth. They bought their own stock at a premium right before the valuation collapsed.
It is the ultimate investing sin. Buying high and watching it drop. It's the exact opposite of what responsible capital allocation is supposed to achieve. They essentially set billions of dollars on fire just to mask the underlying weakness of the stock.
Moving to point 6, risk warnings.
So if the margins are compressing, the cash flow is strained, and they've torched billions on poorly timed buybacks, what are the landmines we need to watch out for in the near future? Because things can always get worse.
They absolutely can get worse. I have outlined the 3 most severe threats found buried in the fine print of the 10K and management's notoriously vague outlook statements. Risk 1 is the China sluggishness.
Okay, what do they say about China?
On the earnings call, CEO Elliott Hill admitted that China is on a longer road, and the reset requires a fresh way of thinking. Let me translate that from management speak for you. They are aggressively losing market share in what used to be their greatest, most reliable growth engine.
Really?
Yes, domestic Chinese athletic brands are rapidly out-innovating them, operating with faster supply chains, and Nike's premium positioning in Asia is eroding by the day.
And China isn't just any market. For the last 10 years, China was supposed to be the foundational pillar for Nike's next decade of hypergrowth. If that pillar crumbles, the whole structural valuation of the company shakes.
Precisely. The growth narrative was entirely dependent on a rising Chinese middle class buying Jordans.
Right.
That is no longer a guarantee. Risk 2 is the EMEA decoupling.
EMEA being Europe, Middle East, and Africa.
Correct. The Q2 call explicitly highlighted that the EMEA market is decoupling from North America's progress. While North America showed some localized wholesale resilience, EMEA is lagging significantly.
Why does that matter so much?
This geographical divergence means they do not have a unified global recovery. Instead, they have isolated regional fires they're struggling to contain, which forces them to spread their turnaround resources incredibly thin.
And what is the third risk? Because usually these are operational, but I think you found something structural.
Risk 3 is cybersecurity, and it is hidden deep in Item 1C of their annual 10K report. I noted a highly specific, almost defensive language regarding the increasing complexity and sophistication of techniques used by bad actors to obtain unauthorized access. They explicitly warn investors that an attack could persist for an extended period before being detected.
Why is that specific to Nike? I mean, every big company faces hackers, right?
Because Nike has bet its entire future on a digital-first, app-driven infrastructure. They store immense amounts of consumer data, shoe sizes, credit cards, location data from running apps.
Oh, right. SNKRS app, Nike Run Club.
Exactly. For a company so reliant on digital sales, this is a systemic vulnerability. A major breach wouldn't just be an IT headache. It would cripple their primary direct-to-consumer sales channel overnight and absolutely destroy consumer trust.
Okay, I hear the warnings. The balance sheet is stressed, the cash flow is negative, and international markets are stalling. But we cannot completely ignore that Nike still possesses massive entrenched advantages.
Moving to point 7, opportunities and strengths. And I say that with extreme reluctance. I challenge you to prove the moat here, because the numbers are simply not showing it.
Challenge accepted. Because if you look past the immediate quarter, you have to look at the sport offense strategy that Elliott Hill is actively implementing. There are real strengths here. First, strength 1, North American resilience.
Let's hear it.
In Q2 2026, wholesale growth in North America was over 20%. That is a staggering number for a mature brand. It proves that when Nike actually aligns with its strategic retail partners instead of fighting them, the brand still possesses massive gravitational pull. Consumers walk into a store and they still want the swoosh over the competitors.
I hear the 20% figure, but go on. What else?
Strength 2, the innovation pipeline. The core of Nike has always been product. I'm looking at their upcoming pipeline, and it's genuinely revitalized. They aren't just resting on retro Jordans anymore.
What's in the pipeline?
They are launching the Nike Mind platform for holistic training. They have the Structure Plus running shoe engineered to capture the massive everyday runner demographic, and the Therma Feet Air Milano jacket launching at the Winter Olympics.
A jacket.
But listen to this. This jacket literally inflates from a lightweight shell into a full puffer based on the athlete's body heat and warmth needs. That is exactly the kind of jaw-dropping, athlete-centered innovation that built this company in the 70s and 80s. And finally, strength 3 is portfolio breadth. They have the unmatched ability to unify the Nike swoosh, the Jordan Jumpman, And the Converse star chevron across multiple sports, multiple generations, and multiple price points. They dominate the cultural conversation in a way absolutely no other apparel brand on earth can match.
I will acknowledge the strong, historic brand equity. The swoosh is a globally recognized, incredibly powerful moat. However, I must remind you, and the listener,
Yeah.
a great jacket that automatically inflates at the Winter Olympics is a very nice marketing story. It looks great on a billboard.
It does.
But until that jacket fixes the 40.2% gross margin we discussed earlier, it is just expensive fabric. Innovation only matters to the balance sheet if it commands premium pricing, avoids the markdown bin, and actually converts to cash flow, which, as we have exhaustively established today, is currently not happening.
Fair enough, but you can't completely discount the leadership trying to steer this massive ship. I mean, they know the problems exist.
Moving to point 8, management credibility and capital allocation.
I think we have to give CEO Elliott Hill some credit for his transparency here. He is not hiding the ball from Wall Street. On the earnings call, he used a baseball analogy, explicitly stating that they are only in the middle innings of our comeback and acknowledging that greatness is earned, not promised.
Very poetic.
He is openly admitting the road ahead is tough. That kind of candor is rare.
Transparency is only valuable if it is accompanied by strategic consistency and execution. I'm going to cross-reference management's past statements with their current actions because the contradictions are glaring and severely undermine their credibility. Let's look closely at the channel flip-flop.
The direct-to-consumer thing.
For years, previous management insisted to investors that Nike Direct, selling straight to consumers through the SNKRS app, the Nike website, and their owned retail stores, was the holy grail of retail. It was pitched as the ultimate driver of permanent margin expansion. The logic was simple: cut out the middleman, keep the entire profit margin.
Right. That was the dominant narrative for the last 5 years, easily. We don't need the department stores anymore. We own the customer relationship directly.
Exactly. Now let's look at the grim reality in Q3 2026. Nike Direct revenues are actually down 4% on a reported basis and down a terrible 7% currency neutral. Meanwhile, wholesale revenues, the very middlemen they try to aggressively cut out and alienate, are up 5%.
So the exact opposite of what they promised Wall Street is happening. The apps are shrinking and the old school stores are growing. Why did the direct strategy fail so badly?
Because management vastly underestimated the hidden costs of customer acquisition. Nike spent 5 years burning bridges with retailers like Foot Locker to build their own apps, only to realize that apps do not organically acquire customers the way a prime display window in a busy shopping mall does.
That makes total sense.
When you cut out the retailer, you suddenly have to pay for all the digital advertising, the localized shipping logistics, and the massive return processing yourself. The margin expansion was a myth eaten up by these hidden costs. Here is the ultimate assessment of management. They have completely reversed their core strategy. They are currently on quarterly earnings calls celebrating a return to wholesale, because their highly touted direct-to-consumer pivot fundamentally failed to sustain growth.
So they're just walking it all back.
I say this directly to you listening. You simply cannot trust 3-year financial forecasts from a leadership team that completely changes its core operational playbook every 18 months. They burned retailer relationships to build direct, and now they're crawling back to those exact same retailers, likely offering massive margin concessions just to get shelf space back, which perfectly explains why the gross margin dropped to 40.2%.
Wow. That perfectly connects the macro strategy failure directly to the margin decay on the balance sheet. They lost their leverage with the wholesale partners, and now they're paying the price.
Moving to point 9, the forensic final verdict.
To summarize the emotional and cultural core of the brand we started with, it is still Nike. It remains a cultural behemoth with a fiercely dedicated following, a genuinely revitalized product pipeline heading into major global sporting events, and a management team that is at least publicly acknowledging they are in a brutal fight for their legacy.
And here's the uncompromising financial synthesis based entirely on the ledgers. Earnings quality, poor. The widening gap between flat reported revenues and a 20% spike in accounts receivable heavily suggests aggressive accounting and channel stuffing to mask softening consumer demand.
Right.
Operating sustainability deteriorating. The 5.6% EBIT margin is a fraction of its former self, continually dragged down by what management falsely claims are one-time severance costs, but which are actually recurring penalties for constant failed strategic resets. Capital allocation, destructive. Paying a dividend that exceeds net income by 17% while executing terribly timed stock buybacks that preceded a $16 billion drop in market capitalization is actively draining the balance sheet of vital flexibility when they need it most.
So after digging through all these 10Ks and earnings transcripts, what does this all mean for the listener tracking this company or managing their own portfolio?
Next time you see a legacy company loudly advertising a brand new win now strategy, ask yourself this fundamental question. Are they playing to win the game, or are they just trying to hide the score?
That's a great question.
Look past the flashy product announcements. Take a hard look at the receivables line in their next quarter, because that is where the real, unvarnished story of this comeback will be written.
A fascinating and completely sobering reality check. Thank you for joining us on this deep dive. Remember, the cinematic narrative is rarely the whole story. We will keep tracking the numbers so you don't have to. Until next time.